The IRS is reportedly hiring 1,200 new employees to help the agency in what is predicted to be a very challenging tax filing season, perhaps the most in years. So let's talk about how perhaps you can best prepare. Joining us now is Jamie Hopkins, Managing Partner of Wealth Solutions at Carson Group, as part of our Financial Advisor Corner to help us with some of these questions. So I guess first up, with that precursor that the IRS is going to be swamped. They're already swamped. They're still working through the 2020 stuff. What do people need to know now? I mean, should people be filing as early as possible, for example?
Yeah, it's a great question to ask. What should people know about taxes right now, being that there's still a lot of returns not processed from 2020? I put people into two categories here with should you file quickly or slowly? There's one group that if you're looking for a refund, you expect a refund, your taxes didn't really change a whole lot from last year to this year. Tax season is open. You can start filing. So get those in as soon as possible. The longer you go, I actually think the more likelihood is that we're going to see delays as things break down, as some complexity arises. So if you're looking for a refund, get that in quickly. Now, if you're in a little bit more of a complex tax situation, I've been telling some people to maybe hold off for a little bit. I don't think it's super likely, but there's still conversations in DC right now. There's governors that were on TV last week talking about they would still like to see some retroactive tax changes to last year. As I said, I don't think that's super likely, but if you're in a more complex situation, just making sure you get everything documented, that you feel good about heading into tax season. I see it every year where people rush in, they don't have all their forms. Maybe they've got partnership forms and other forms that are delayed right now. They're filing things and then having to amend after tax season kind of closes out on April 18th this year. And that creates additional complexity. So if you feel that you've had a complex situation in the past, you've got additional state income, I'd say, maybe even consider filing an extension or waiting. That doesn't get you out of the taxes you owe, but there are really two different groups of people there when you're thinking about should I rush to get in or should I take a more measured approach?
For those trading that have been trading crypto very aggressively, or traded aggressively last year, what's your advice to them as they approach tax season this time?
A piece of advice on the crypto side is, look, this has been taxable for a long time. The IRS considers exchanges, trades in non-qualified accounts, which is most of the situations in which you're going to be trading crypto. Any of those times where really any transaction occurs, it's a potential taxable event. Unfortunately, most people have not been tracking that. They haven't been tracking their cost basis, the interactions that they're having. I even heard an accountant say this recently. Oh, I took all of my crypto and I bought a vacation, so it's non-taxable. And just staying there being like, we've got accountants that are getting this wrong. So first of all, it's track it and report it. The IRS is getting reports now from a lot of the major crypto exchanges. So they do know what you're doing. If those things are not matching up, you could find yourself in a little bit of trouble. That wasn't always the case 2-3 years ago. If you go back to President Joe Biden's budget back in last April, looking back there, he actually said, look, we expect to get more tax revenue than ever before from crypto. And so the IRS is going to be honing in on that. I did see some of the exchanges are starting to send out some tax forms. I saw that in the last couple of weeks. So if you're getting one of those, or even if you're not, but you are heavy, as you said, in trading, exchanging, anything with crypto, make sure you talk to your tax professional. And it is on the form now. Your 1040 will ask about crypto.
Very, very important note for folks, for sure, Jamie. When it comes to deductions, I know you noted to us that IRA contributions tend to be overlooked. What do people need to do when it comes to those contributions?
The IRA contributions get overlooked in the sense that a lot of people think, well, it's, we're now in a new year, so I can't make contributions for last year. If you read up on financial planning articles, you're going to see people talk about that all the time. But we can make those IRA contributions for 2021, last year, all the way out until this year, April 18th, which is our tax return date for, our 2021 returns. So you can put, $6,000 into into a traditional IRA, deduct it per spouse, $12,000. And if you're over age 50, you can do an additional $1,000 per person. So all of a sudden, we're talking about a $14,000 potential way to save for your future retirement, invest inside the IRA, and create a tax deduction. That's just often overlooked because we're thinking about this year. We're thinking about moving forward. The same is true for Roth IRAs, although we won't get a deduction, and HSAs, health savings accounts. If you're in a high deductible plan, that one is probably arguably overlooked even more, to go fund that HSA for the last year. And I consistently tell people, if you were in a high deductible plan, you really should be. If you have the financial means to fund the HSA, you should be considering it. It's one of the best benefits from a financial planning standpoint or tax standpoint from having an HSA and high deductible.
Good things to keep in mind across the board. Jamie Hopkins, thank you. Managing Partner of Wealth Solutions at Carson Group. Appreciate your time this morning.